Bypass the bank or credit union, which is really just a middleman, and keep your emergency funds where they do. In this episode, you will understand why a max-funded IUL is the dream solution for an emergency fund. Get ready. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 48 years. And I've helped many thousands of people to be able to optimize their assets and minimize taxes and empower what I call their authentic wealth. And so many times when I would meet with clients and they would come in to reposition underperforming or non-performing assets, many times I found that people would have $50,000, $100,000, $750,000, even in excess of $1 million sitting in a bank or a credit union. And it's been sitting there maybe for months or years. And I would ask, so what is this money in the bank earmarked for? I remember one woman, she said, well, I was thinking about taking a trip. And I went, to the moon? Hello? Well, sometimes people don't know where to park money. They're afraid of investing in the volatile stock market or whatever, and so they just put it in a bank or credit union. The problem is, the last couple of decades, the rate of interest that is credited by banks and credit unions has been pathetic. I mean, back in 1980, 6 years after I first started, I started in 1974, CDs at banks were paying 10%. Inflation was double digit, but now many banks and credit unions are crediting less than 1%, which is ridiculous. But it's like rowing upstream, so to speak, at a rate of 1 mile an hour, and the current of inflation's coming down at 3, 4, 5, 6, 7, 8, 9, and you're going backwards. And so sometimes people think, well, I want to keep my money in a bank or credit union because it's safe or it's liquid. I can go to the drive-up window and I can access my money. And so they think that means it's liquid. Well, actually, it may not be as liquid as you think just because it has a drive-up window. In this day and age, you can access money with an electronic funds transfer or a phone call. And so money is actually very liquid, even though it might be across the country in a financial institution like a multi-billion or multi-trillion-dollar insurance company. Now, here's something that shocks a lot of people. I say, do you know where your bank or credit union takes your money? Do they put it in a vault and they're just being benevolent and crediting you interest? No. So what are they doing with your money? And most people say, well, they're loaning it back out again. Yeah, well then how do they have the liquidity to be able to give you your money if you walked in and asked for your money? Now, if push came to shove and there was a panic, a run on banks, they technically, legally have up to 6 months they could stall you from withdrawing your money out of their institution. Most people don't realize that. People feel, okay, it's got FDIC insurance, what have you. But there have been periods of time where FDIC has been technically broke, but we know the government has the ability to tax us or print money. And so we feel somewhat at ease that we can access money in most emergencies if it's parked in a bank or a credit union. Okay. Now, the fact of the matter is, in 2008, there were over 400 banks that went under. There were 900 more that were on the watch list, on the brink of going under. And so a lot of Americans don't realize how close we came in America to a total financial collapse, and you would have had to have waited at least 6 months to get your money out of a bank. The federal government asked in 2008 the 5 major banks in America to disclose where they had their tier 1 assets. Those are assets that they must have on hand, liquid and safe, they can access readily in the event of a major run on their bank. Guess where the 5 major banks disclosed they had 30 to 40% of their tier one assets in insurance companies, oftentimes in what is called BOLI. That's an acronym that stands for bank-owned life insurance. So people go, what? The bank owns life insurance on people? Who? Well, it could be their board of directors. It could be stockholders. The point of the matter is, why do they do that? Because the owner of an insurance policy gets all of the tax-free accumulation, all the interest and everything. The owner is usually the insured, but it doesn't have to be. In fact, COLI, C-O-L-I, is corporate-owned life insurance. There's a lot of corporations that keep their assets parked in insurance policies in cash value, but they have to have an insured that has the insurance on them, even though they may own the insurance policy. Okay? And so what I've been telling people, if this is where banks and credit unions put 30 to 40% of their tier one assets for liquidity in case they need to get money and safety. Now, a lot of times we think banks are safe because of this FDIC insurance. Well, the fact of the matter is there's a lot of rating agencies. We'll use S&P, Standard & Poor's. Unfortunately, a lot of banks in America are only rated maybe triple B by S&P. You look at most of these insurance companies and they're rated AA or AAA. What is the difference between AAA and triple B? About 6 notches higher in safety. So banks are taking your money that you park in their institution, and to increase the liquidity and the safety by maybe 5 or 6 notches higher, they're taking a portion of your money and putting it into multi-trillion-dollar insurance companies because they're the backbone of America, the backbone of the world. They came through the Great Depression with flying color when banks closed and 40% never reopened again. Not one single legal reserve insurance company went under in the Great Depression. Same thing happened in 2008. Not one single legal reserve insurance company went under in 2008. So they're increasing the safety, but also the rate of return. Banks, let's give them the benefit right now as of the recording of this video. They're crediting less than 1%. Let's say 1%. So on every $1 million that the general public loans the bank, because there's only 4 things you can do with money: spend it, lend it, own with it, or give it away. When your money's in a bank or credit union or in an insurance company, it's in a lended position, okay? You're loaning them your money and they're paying you interest. So they are borrowing OPM, other people's money, and they're paying you, let's say 1%. On every $1 million, 1% would be $10,000 a year they're paying in interest. Now, in 2008, they were turning around and putting 30 to 40% of their tier one assets in insurance companies, and their average earnings at that time was about 5%. How much more is 5% than 1%? Don't say 4%. It's 5 times. It's 500% more, meaning on $1 million, they only have to pay $10,000 in interest to you, the depositors, okay? And they turn around and make $50,000. Let me reframe this. Would you hire an employee for $10,000 that made you an extra $50,000? That's a 500% return on employment cost. Would you buy a widget machine for $10,000 that made you an extra $50,000? That's a 500% return on employment cost. Business owners understand this. So you can bypass the middleman. You can put your emergency fund directly into the places where banks put your money when you put it in their institution. And if you need to access money in this day and age, you could access it in 2 or 3 days pretty easily. Most emergencies don't require you need money within 24 hours or less. But if push comes to shove, you can actually have money wired out of the insurance company, out of your indexed universal life insurance policy, which is where I put my serious cash as an emergency fund. So that's why a max funded IUL is one of my favorite, dream solutions to have money on hand for liquidity, safety, and earning a better rate of return by 5 times what banks and credit unions do. And it may not have a drive-up window, but I can access money just as easily with technology as if there was a drive-up window. So this is why I really help people understand, if you want to have an emergency fund, that is actually more liquid, safe, and earning a much better rate of return than a bank or credit union, I would only keep maybe 10 or 20,000 or 60 days or 90 days worth of income in a bank or credit union, if that makes you feel better. But where I put my serious cash as an emergency fund is to bypass that middleman, the bank or credit union, and put it into an IUL policy where I can access the money. And in the meantime, I'm my own banker, so to speak. So if this is intriguing you, let me help you understand how you can learn more about this. I want to gift you a copy of my most recent best-selling book called The Laser Fund. Now, this has been flying off of our warehouse shelves. I don't want you to miss out. This is actually 2 books in one. This side, the white side, is about 200 pages, 14 chapters that has all the charts and graphs and explanations of how you can diversify and create the foundation for tax-free accumulation for long-term goals like retirement, but even an emergency fund. If you learn more by stories and examples, you flip the book over to this side, and this is about 100 pages, 12 chapters, and they have 62 different stories that we have in here of ways that the Laser Fund, which is a max-funded IUL policy, can be used as the dream solution for many goals, including an emergency fund. Here's how you can claim your free copy. Simply go to laserfund, L-A-S-E-R, fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I cover the rest of that. I'll pay for the book. You don't have to pay $20 on Amazon or more. They're even selling it on Amazon for more than $100. I will gift you a copy. You contribute the nominal amount towards shipping and handling, but when you're in there, there's going to be options to listen and learn, watch and learn. You may even want to check out some of the educational webinars that we do online, because this is about you and your brighter future.